My name is Charles Miano. I serve as portfolio manager here at Nabu Capital. And in today's video, I want us to go through what shares are, not only shares but equities, and a better understanding of what the equity fund is all about. So basically, we can call it a crash course in equity markets in Kenya. So where do we start? First, it's basically understanding the basic definitions. So we typically hear about shares, right? And we hear about equities. And particularly, these two words we've had it over the past 2 years. And why so? Because in the Nairobi Securities Exchange in 2024 delivered returns of 34%. And in 2025, last year, it delivered returns of 51%. Phenomenal returns. And there's been a huge amount of our clients as well as the masses asking, okay, how can we participate in this particular asset class? And so we wanted everyone to understand what that means, what that 34% that was made in 2024, what that 51% that was made last year actually means, and how you can participate directly. And so what are shares and equities? They're basically the same thing. So what they are is ownership. So whenever you invest in shares or equities through the stock market, you take ownership in a company. For example, if you're investing one share in Safaricom, to use that company as an example, it means you own one stock and you own a certain percentage of that company. So shares, equities is same thing, and what this means is ownership. Okay, so it's ownership. Okay, and beyond this, once you own a company, what does that mean? It means you benefit from two things. So your ownership gives you, first thing is when the company does well and they're profitable, part of that profit, they can pay an income to the owners of that company or to their shareholders. So ownership, which makes you a shareholder, okay? So you become a shareholder. And when you're an owner, you get two benefits I've mentioned. When they pay you part of their profits, they pay you something called dividends, which basically is income that you're paid, depending, company can pay you on an annual basis or semi-annual, or so dependent on the company. And the other way you can benefit as an owner is what we call capital gains. Okay, so capital gains means when the company, so your ownership, shareholder of a company, okay? So when the company does well, for instance, where a company does, they are able to increase their revenue, say manage their costs well, and book good profits, the share price of this particular company that is listed in the stock market can go up. So share price goes up. Share price goes up. So when the share price goes up, then you are able to get capital gains. So for example, you buy a stock or a company, or a share of a company at 10 shillings per share. Okay, you just pay for that one share. The company books record profitability. It's grown quite well, double-digit growth, management are solid, etc. And the price, so the price goes to 15 shillings a share. Okay, so what this means is you've booked a profit. The difference between the two means your 5 shillings profit. Okay, so that 5 shillings profit translates into what you'll call now a 5 you'll get a 5 shilling capital gain. capital gain, okay? And so typically you'll hear this, but what you typically hear in the markets, you'll hear of a percentage gain on this. So the difference between these two is 5 shillings. That 5 shillings, when you translate that into a percentage return and say you booked that means you've gained a 50% return, on this share, on this company, okay? And so this is how the dynamic works. And what makes it interesting for companies is you're an owner of a company, right? There's 2 scenarios where we can see the outcome of a company, right? You can see the company in this scenario do well, where it has good growth, good management, they book good profitability, and the share price goes up. And when the share price goes up, assuming you bought your 10 shillings, goes to 15 shillings, you make your 5 shillings profit, and you make a capital gain, which is of that 5 shilling, which is equivalent to 50%. But also the company can also pay dividends. So you're making two sources of return. That is dividends and capital gains. However, the inverse of this is you can invest in a company. So this is company A, let's assume. You invest in company B. Same thing, you invest 10 shillings, right? But now, this is your 10 shillings per share, which is your cost. But now the share price, instead of going up, as similar to this, the company books losses, lower growth. For example, the MD is replaced, or the CEO is replaced. There's a bit of wrangles in this particular company, and so the share price drops to 5 shillings per share, right? So that means you've booked a -5 return, okay? So this becomes now a loss. And so when you look here, instead of making a capital gain, you've made what, again, we call a capital loss. Okay? And now, typically now, this is the outcome that you get when you invest in a stock market. The NSE has over 50 plus companies. The outcome of these various companies can go either or. It can go scenario 1, and it can go scenario 2. Okay? So where shares can go up, you make a profit. Where shares can go down, and you make a loss. And that's why when you ask yourself, why do they say equities are risky? It's because of the scenarios here. It can play out either way. And in particular, it can play either way because of various reasons. It could be a factor of what's happening in the country. It could be a factor of what's happening in the industry. It could be a factor of what's happening specifically with these particular companies. But also, over time, given that you're an owner in this particular company, and especially if you're able to select a good company, then you can be able to compound your returns quite well. If you see this scenario where you invest in company A and you make a 50% return in one particular year, this company could continue growing in a similar trajectory over time, and you could end up compounding your return, doubling your money, even tripling your money. But the inverse of that is if you're investing in a company that's not doing so well, then you can actually lose your capital. And that's why equities are preferable for someone who understands it, one, and someone who understands that high risk, high return. So in the field of finance, we say there is no free lunch. There will never be any free lunch in the field of finance. So if you're making a high return, expect that there is a commensurate, or not even commensurate, but to some extent, there is some level of risk you have to absorb. And that's why, for example, a money market fund, which is the lowest risk form of investment you can take, the risk is quite low, but the returns also similarly are not as high. You will never hear of making 50% in a money market fund, and because of the risk that is embedded when you invest in that. So I just wanted to give a sense of this is how the market works. But now another question that comes in and people think about is, what makes the price go up and the price goes down, right? We've talked about dividends, which is just profit that is booked by a company where management and directors decide that they'll pay a certain part of that income to shareholders. Capital gains, on the other hand, is where capital gains or losses where share price goes up or down and you benefit or lose from that. So what makes all this move is all this happens in a stock market. Basically, imagine like your typical market where you have various companies all competing for your capital. And so when you have various players, various companies, various shareholders all competing and trying to see which company will do well, the force of demand and supply comes in. Okay, so when let's use this company A as an example. It's reported its financials. They've grown by 30%, for instance. Their profit has grown by 20%, and they are looking to expand beyond, for example, Kenya, and they're looking to expand to the larger East African region, let's say Uganda, Rwanda, etc. So there's good news that this company is likely to do even better because now they're expanding beyond Kenya and there's opportunity there. So what happens in the market, this stock market, is now the investors think, okay, it's gonna do well, so the demand comes up. And as you understand the law of demand and supply, when there's high demand, and this is a law that applies all across, the fundamental law of economics. When there's demand for a certain good, or in this case a stock, when there's a high demand, the price goes up because someone wants to buy from you because they think this company is going to do phenomenally well, and so the price goes up. And that's what we've been seeing in the stock market the last 2 years, where we've recorded the 34% I spoke about earlier, the 51% last year, is because companies largely have been doing well. The banking sector, the telco sector, the manufacturing sector, they've been doing well, and so there's been demand for the price to go up. The scenario 2 here, company B, not doing so well. So they report lower profitability. There's the industry has some regulations that are not favorable, and hence there's an outlook based on the poor profitability the company has reported that in the future this company might not do as well. So what happens is a lot of investors now in the market, there's low demand for this share. So the investors, the companies, I mean the institutions, they start selling off this company B in the market because there's no demand for it, and so the price starts going down. And when that price comes down, hence you book the loss. And that overall is how the market works, from gains when a company does well to losses companies doesn't do so well. And also this is not just based on the companies themselves, but also based on what happens in that particular country. If a country is in political wrangles, the currency isn't doing well, it has very high debt and a debt that is unsustainable and they're unable to pay, then these companies are affected because they all operate in the same macroeconomic environment. Okay? And so as we look at, as mentioned, those are shares, then now question comes in, how does an equity fund that, for example, that NABO has come in and help you? Okay? So last year, we were able to book a return of 42%. This year, for the first month of January, we were up 3.5% for that particular month. And so what are the benefits that comes to you when you invest in a fund? Okay, so you can invest, as I mentioned, in company A, company B, can go either way depending on how the performance of that company. But now what an equity fund does is it simplifies for you. How does it simplify for you? The first thing it does is there is professional management. Okay, professional management. So our job is to find out, to choose more of company A, the companies that are doing well, the companies that are cheap to purchase, the companies that have a really good outlook and that will generate the type of returns that will make you wealthy, the type of returns that will be satisfactory, right? And so that is our day-to-day job. So you get the professional management of ourselves, as portfolio managers, the analysts, and everyone in the team looking at these stocks daily and doing in-depth research, doing in-depth valuation to find out which is the best company to choose from, because you have a vast array of companies, as I mentioned, 50 plus companies. So how do you select, for example, the best 10 that you think can do well, right? So you have that benefit of professional management. The second thing that you get is diversification, okay? So we're able to diversify and allocate to different sectors, type of companies, and allocate in different ways. So you're not just losing out, for example, if company B, as I use as an example, does poorly, you're not wiped out. Meaning that even if one company does not do so well, you still have other companies that will lift up the rest of it. So it reduces your risk. So this one overall reduces your risk, right? And last one, what you do is, we call it easy access, right? It's very simple. If you want to invest in an equity fund, you just you sign up for a fund. For example, you sign up for an Abo capital fund, and you're able to start as soon as you have your KYC and you've done everything, you send your money. It's easy to invest. If you were to look at doing it yourself, which you can, which is okay. First, you have to open various accounts, for example, the CDSC account through a broker. So you have to select the broker number one, which broker is going to be. That's another choice. Second, you get your CDSC account. The third one, which is the most important one, which stock do you buy? How many of us have the time to go through each stock and analyze them and do valuations, do research, follow the news? How many of us? So the equity fund gives you that ease of access, in that you get the professional management ourselves, as looking at these stocks on a daily basis to select the very best. The second you get is diversification. We're able to allocate across different stocks that can do, that we foresee that will do well for that particular period of time. And then now you get the ease of access, that it becomes easy for you just to you just invest your money, and then we allocate, and now you're able to take that benefit. So when it comes to our equity fund, I can note certain features. For instance, for the NABO equity fund, the minimum amount to invest is Kenya shillings 100,000, with a top up of 10,000 shillings minimum. The lock-in period for that particular fund is 6 months, and we categorize it as high-risk fund. So as I mentioned in that example, past returns are not guarantee of future results. We did 42% last year. This year, the trajectory is looking positive in terms of where the market is. However, there's no guarantee that we can do the same return as we did. What we do is select good stocks, solid stocks that can be able to do well for your portfolio. And so this fund now gives you the best access into the Kenyan equity market, and gives you that ability to have that diversification, that ease of access, that professional management that will make your investment journey a sweet journey. Also to note, part of why we are positive in 2026 is because of 2-3 things. One, interest rates have been coming down over the last 2 years, meaning that as interest rates come lower, the fixed income returns are lower. And so we've seen a migration in investors from lower fixed income assets like bonds, T-bills, money market funds, into stocks which potentially give high returns. The second thing is the fact that over the last decade or so, it's been a difficult period for Kenya, especially the corporate market, the industrial sector, as well as the stock market. And one, driven by a bit of a lot of political upheaval. Second, COVID-19. Thirdly, high inflation, high interest rates. And so that led to very cheap, the market being very discounted. And so the market now has very good stocks that have been profitable and booking good growth. but they've been very cheap, and hence investors have been able to capture this. So we're talking about investors like me and you, individuals, but also companies have been shifting and tilting their portfolio from fixed income to equities and adding a bit of that allocation, which helps. And thirdly, is the currency has been stable since 2024 and into 2025. We've seen more confidence from foreign investors to come in and allocate capital into the market. And so if you look at those catalysts, that momentum is still peaking from 2024 into 2025, and we're seeing the same momentum into 2026. And so I think with that, we now, I hope, have a better understanding of what the equity fund is all about, specifically the NABO, but just understanding overall what an equity fund is. And we look forward to engaging further. If you have any questions, please let us know. We are happy to help you and guide you through this journey of investing with purpose, and this journey of participating in the stock market through our equity fund.